In 1930, a New York bank called the Bank of the United States opened its doors one morning to find a queue stretching around the block. The people in the queue did not want to make a deposit. They wanted their money back. By the end of that day, the bank was effectively bankrupt. Not because it had done anything particularly unusual, not because its loans had all collapsed, but because too many people had decided, at the same moment, that they wanted to leave, and banks can never give everyone their money back at once. This is called a bank run, and it is the mechanism that turns a small problem into a catastrophe. Here is how banks actually work. When you deposit money in a bank, the bank does not put it in a vault with your name on it. It lends it out. Under the fractional reserve system, banks hold a fraction of deposited funds, roughly 5 to 10%, available at any time and lend the rest. The entire business model depends on the assumption that not all depositors will want their money back simultaneously. For most of banking's history, that assumption is correct. But it only takes a rumor to break it. If enough depositors hear that a bank is in trouble, even if the rumor is completely false, and they rush to withdraw their funds, the bank cannot meet the demand. When it cannot meet the demand, it stops making payments. When it stops making payments, the rumor that started as fiction becomes fact. This is what economists call a self-fulfilling prophecy. What happens after a bank fails? In most modern countries, a government agency steps in. In the United Kingdom, this is the Financial Services Compensation Scheme. In the United States, the Federal Deposit Insurance Corporation, the Fdic, was created in 1933 directly in response to the bank failures of the Great Depression. These agencies do one thing. They guarantee deposits up to a set limit. In the UK, that limit is £85,000. In the US, $250,000. If your bank fails and your savings are below that limit, you get your money back. Not from the bank, but from the insurance scheme that the banks themselves collectively fund through annual premiums. What about the bank itself? The bank does not simply disappear. Regulators intervene. Typically, this takes one of three forms. A healthier bank acquires the failing one. Depositors wake up the next morning and find their accounts have transferred automatically. This is what happened when Silicon Valley Bank collapsed in 2023. Most of its deposits were moved to a bridge bank within days. Alternatively, the government intervenes directly. In 2008, the British government took an 84% stake in the Royal Bank of Scotland to prevent its collapse. It took 12 years to sell that stake back. If no buyer appears and government intervention is deemed too costly, the bank enters administration. An administrator is appointed, assets are sold, and creditors are paid in a strict legal order. Secured creditors come first. Bondholders next. Shareholders receive whatever remains, which is often nothing. In every case, ordinary depositors are protected first. The people who bear the most risk in a bank failure are the ones who knew they were taking a risk, investors and shareholders. The real danger in a single bank failure is not the bank itself. It is contagion. A bank failure triggers fear about nearby institutions. Depositors at other banks start worrying. Withdrawals begin. Those banks start to struggle. Within days, an isolated failure becomes a systemic crisis. This is what happened after the Bank of the United States collapsed in 1930. Within 2 years, 5,000 banks had failed across America. The Great Depression was not caused only by the 1929 stock market crash. It was deepened and prolonged by the wave of bank failures that followed it. Regulators drew conclusions from that disaster. Deposit insurance schemes, central bank emergency lending powers, the stress tests that banks undergo annually, all of them were designed to stop a single failure becoming 1,000. They do not always work, but they work far more often than the alternative, which was everyone in the queue at dawn hoping they got there first. Now you know.